Hello everyone, welcome back into another week of exciting accounting world. Last week we've introduced the income statement, also known as the P&L. Today we are diving deeper into one of its most important parts, revenue, and exploring its role in the income statement. Revenue is often called the top line, because it's the first number on an income statement. As we discussed, there are two major types of revenue: revenue from sale of goods and revenue from services. And according to the revenue recognition principles, revenue is recorded when it's earned, even if the cash comes later. Let's start with goods. Goods are tangible. When we sell the goods, we can see and touch them. So, when we sell them, we physically separate them from us. We hand them over to our customer. But when does the sale officially count as revenue? Is it when you sign a contract or shake hands? When the goods leave your warehouse? When they are loaded onto the delivery truck? Or maybe when they are delivered to the customer and the customer physically has them? To confuse you a bit, all of this is possible. Yes, the moment you can consider sold goods as your revenue can be different. The answer depends on the contract with the customer. The moment you can say, I have sold the goods and can record revenue, is normally when you transfer all the rights and risks of the product to your customer. From that moment, you don't own the goods any longer. You have no risks associated with the product. It now belongs to your customer. And that moment is called transfer of the ownership. For example, when you go to the shop to buy some bread, you own the bread only after you paid for it. So the shop can record revenue only after the payment has been made. Ownership and payment happen together. Your revenue is equal to the cash you have received, and you correspondingly reflect that on your balance sheet and in the P&L. Always two transactions, remember that. Now imagine ordering a table. It is delivered to you and you get an invoice. But you own the table already when you accept the delivery and the invoice. Then you have, for example, 30 days to pay for it. But the sale already took place. And that's why the seller can record the revenue already when he delivered you the table. In this case, revenue is equal to the invoice amount, and the seller will record revenue in the P&L and receivables from you on the balance sheet. Again, two transactions. Now let's talk about services. Services are trickier. You cannot touch or physically move or separate them. A taxi driver or a hairdresser, they do not reduce the ability to provide services or quantity of those services in the future after they have delivered these services to you. You don't own the service as such. You own only the result of it, or the right to access it. For example, your subscription for video streaming services. You don't own the movies you watch, but you have a right to access them. So, how do you track the services? How do you confirm they have been delivered? How do you know that the result of the service has been transferred to you and the supplier fulfilled his obligations? Normally, you would agree with the supplier that you accept the service or the result, and that would be the reason for them to recognize revenue. But you may ask, how to deal with the situations where it takes a few months to deliver a service? For example, if you are painting a large building or doing some significant research. You are continuously performing your services every day, every hour, and even if they are not completed yet, you deserve to have recognition for that. In these cases, the most common approach is to recognize revenue as you progress. It is a so-called percentage of completion method. Let's say your project takes 3 months and you will be paid $300 after those 3 months. And let's imagine you work consistently, every day, same hours. In this case, you can say that your 3 months' work can be split into 3 equal parts, 1/3 per month. And based on this, you can record your revenue as 1/3 of the total every month, despite the fact that you will deliver the results to the customer and get paid only in 3 months. So, you record 1/3 in month 1, the next 1/3 in month 2, and the final 1/3 in month 3. You will record $100 each month and accumulate that until you reach 300. And you reflect that correspondingly in your balance sheet and your P&L. You accumulate receivables and you accumulate revenue. And of course, in the end, when you're getting paid, your receivables in the balance sheet are replaced by the cash. You see, recording revenue for services can be tricky, but there is a solution for that, and nothing is impossible. In addition to these two major types of revenue, there are also other types, which are often called other income, and which are not associated with the sale of goods or services. For example, that could be a reimbursement from insurance companies, grants and subsidies you receive from the government, gifts, and so on. You can also receive interest from your deposits in the bank. They all increase your assets or cash, but are not associated with selling goods or services to your customers. Okay, we discussed the revenue and its recognition, but what are the common revenue mistakes? That, for example, could be recognizing revenue too early, for example, when the ownership has not yet been transferred. Most common, when you receive cash as a prepayment. Double counting, recording both an invoice and cash you have received. Or forgetting to record it properly, for example, forgetting to send the invoice or record the invoice completely. Yes, believe me, that happens too. Here I would need to make a remark. Some managers of the businesses may use cash accounting to simplify things, meaning they record revenue and costs when they receive or pay cash. This is so-called cash accounting. Everything is based on the actual cash transactions. It is easier, it simplifies life, but it contradicts the majority of the accounting rules out there. So we have learned something today, right guys? Let's summarize it. Revenue comes from goods or services. For goods, you recognize revenue when the ownership is transferred. For services, you recognize revenue when the services are accepted or as progress is made. Long-term services are normally recognized based on the percentage of completion. Some income is unrelated to sales, but still counted. In our next lesson, we'll explore unearned revenue and discounts, which are also impacting P&L and are important parts of the income statement. Thank you for watching. We hope this lesson helped you understand the revenue better. If you'd like some further explanations or one of the topics investigated deeper, please drop a short comment. We will look into that. Don't forget to like and subscribe for more lessons on accounting and finance. See you next week in the next episode.